So what do we mean when we say flexible exchange rate regime? Well, they're kind of a whole gamut of different ways that this looks. So we have a free float where the market forces basically determine what the exchange rate is between countries. So Australia, the US, the UK, the Eurozone, Mexico, Japan, major economies that are involved in import and export, um, really driven by market forces. We also have managed exchange rates. Here, if we're talking about a managed float, we kind of have a combination of government intervention plus market forces. And to be clear, all governments are in some degree intervening to figure out how to either stabilize their monetary policy or how to stabilize their exchange rates or how to influence capital flowing in and out of the border. We'll talk about that in a little bit. Okay, so with these managed free floats, we basically have a combination of market forces and then we have government intervention. There's some countries where it's mostly market driven, like Brazil, South Korea, India, South Africa, Thailand. Now, there are also countries where it's really driven in order to keep a very stabilized exchange rate system. So Indonesia, Singapore, and then there are different countries that have their currency pegged to another currency. So just like the currency was pegged to gold before, in the case of Morocco, Saudi Arabia, we have countries that will peg the currency to the value of another currency. We have currency boards. So Hong Kong is an example of a currency board where essentially the government says, we're just going to continue to have our currency at a fixed rate with another currency, and that's it. We're no longer going to have any sort of local exchange rate policy. There are countries that have a crawling peg where you want to keep the rates within a narrow margin. So China, Iran are great examples. And then there are also countries that have no national currency. So some of these countries we think of as dollarized, or countries that basically only function on the euro, that really don't have a local currency. So Panama is a great example. Ecuador, there's a lot of different countries that are dollarized. Okay, so what's the big takeaway? The big takeaway is that as we have these flexible exchange rate regimes, we have many different ways that countries are going to actually let their currency be determined, the price of their currency be determined. And hopefully what you grasp from this is that there's a lot of variation, everything from the free float all the way to no national currency. So let's look at a case that is very relevant, the euro. The euro is an example of, again, a free float, a market-driven currency. Let's understand how the euro came to be, and sort of, it'll be a good way for us to understand the international monetary system. Okay, so how did the euro come to be? First, there was the European monetary system, which involved the European currency unit and the exchange rate mechanism. The exchange rate mechanism was essentially a means for economies within Europe to harmonize their exchange rates, and then also to kind of prepare to have an integrated economy. So we'll look at basically the case of the pound, and we'll kind of study and explain that a bit more. So this was going on during the late 80s, early 90s. After the European monetary system, we have the European Monetary Union. So from 1999 to 2002, 11 of the 15 EU countries adopted the euro as a common currency. In order to do that, they pegged their individual currencies to the common currency. And then, as we talked about last week, they harmonized trade, investment, labor markets, security, all of it. So how is monetary policy managed? Well, it's managed within the Eurozone with the European Central Bank. So the Euro system, it's composed of the European Central Bank and then the central banks across the Eurozone. How do central banks work within the Eurozone? Well, the European Central Bank, the ECB, coordinates monetary policy, forex, holds official reserves, And again, its big policy target is going to be price stability. So essentially fighting inflation. The individual central banks within each Eurozone country also have their own balance sheets. But the vast bulk of the ECB's balance sheet, its assets and liabilities, are going to be held by the national central banks. So they all kind of function in coordination, but then they also have very different local or domestic policy objectives. Okay, so let's kind of understand a bit more of fixed versus flexible exchange rates. So hopefully we can kind of take away from the Eurozone example that in order to coordinate, in order to kind of have a large flexible exchange rate regime across the countries, individually, they all had to fix their exchange rates. They all had to peg their exchange rates to one another in order for that to happen. So let's kind of understand a little bit more about the dynamics of a fixed versus flexible exchange rate. And the hope is that as we work through this example and compare it to the case of a fixed exchange rate, we can kind of see these differences in monetary and fiscal policy and kind of make this a bit more tangible. So let's do the example. Suppose the Forex rate is $1.40 per euro today. And the next slide, we see that the demand for the euro exceeds the supply at this exchange rate. The US runs a trade deficit, meaning it's going to import more from the EU than it exports from the US. So whenever that happens, you're going to supply the market with dollars, okay? With a flexible exchange rate, the USD would depreciate to 160 per euro. That is, the price at which the supply equals the demand and the trade deficit disappears. We'll compare this outcome with flexible exchange rates to a setting with fixed exchange rates to better understand what I mean when I say monetary and fiscal policy are kind of the mechanisms to adjust. So let's look. Okay, so on our left-hand side and our vertical axis, we've got the dollar price per euro, our exchange rate. And then on our horizontal axis, we've got the quantity of euros in the Forex market. Okay, so we have a demand, we have a supply. You can see where the demand $4 per euro intersects with the supply. But what do we have? Currently, the exchange rate is at $1.40. So at that exchange rate, the quantity supplied, that's again what we're putting into the market, and the quantity demand are going to be different. We can see how it's well below what that price clearing is. The difference between those two is really going to reflect the trade deficit. And the way to understand this is that if we have a flexible exchange rate regime, the dollar would depreciate. And as the dollar depreciates, imports are going to become more expensive, exports are going to become cheaper, and the trade deficit is going to be narrowed. Okay, so what's the idea? The main idea is that when we have a fixed exchange rate, then we're not going to really have the same market clearing mechanism. So what if the Forex rate is fixed? Suppose that the rate is fixed at 140 per euro. Then the price won't rise like we saw because again, it's going to be fixed at 140 per euro. What would need to happen to eliminate the imbalance? In order to eliminate this imbalance between supply and demand, we would need government intervention. So the government is going to have to choose some policy to shift demand to get it to equal supply. So how could the government do that? In this example, the example that we saw, we would need contractionary monetary and fiscal policy. What does that mean? Contractionary fiscal or monetary policy basically means you want to reduce demand. So you can do that in a couple different ways. You can cut government spending, you can increase taxes, that's fiscal policy, And then there's also monetary policy. With monetary policy, you would raise interest rates when you want to contract or reduce aggregate demand. You want to reduce investment demand, you're going to raise interest rates. Total opposite of expansionary policy. Expansionary policy, you want to expand the economy. So there you would have an increase in government spending and you would have a reduction in interest rates. And if all of this sounds a bit vague, if you remember back hearing the term quantitative easing quite a bit during the last financial crisis, this is what people were talking about when they said quantitative easing, that essentially the central bank, the Fed, was going to keep interest rates low in order to help expand the economy. So we have these kind of different policy tools that the government's going to use. Let's take a look at what that looks like. So what do we have? First, we can see, again, that the market clearing price, where the demand intersects the supply, that 160 is well above the 140 that we have in the exchange rate market. In order to get demand to meet supply, given this fixed exchange rate, the government is going to have to shift the demand curve to the left. It's going to have to contract the demand. The way that it's going to do that in this example is with a contractionary fiscal policy. So that could be cutting government spending, that could be increasing taxes, that could be putting a tariff on imports, or it could be with contractionary monetary policy by raising interest rates to reduce aggregate demand. Okay, so hopefully, as we've kind of been discussing this, you can get a bit of a feel for the fact that you can't really do everything you want. This is called the incompatibility trinity. Within financial economics, this is often referred to as the trilemma. Here's what it means. It's impossible to have all three conditions at the same time. It's nearly impossible to have a fixed exchange rate, to have the free international flow of capital, and to have independent monetary policy, i.e. setting interest rates and government spending as you want domestically. So the arguments for the flexible rates, the way to think about the trilemma is that you can often pursue two of these policies, but you can't really pursue all three. You can't have your cake and eat it too. If you want to have fixed exchange rates, which are very helpful for business, firms don't really worry so much about hedging, awesome. If you want to have a fixed exchange rate and you want to have an independent monetary policy, then you're going to have restrictions on international capital flows. We'll look at what happens when you don't when we study some of these different currency crises. Pick a different policy. If you want to have independent monetary policy, meaning that you want to be able to set interest rates and determine government spending to achieve whatever domestic, political, and economic goals are important to you, and you want to have the international flow of capital, so you want to be able to attract and receive foreign investment, then you're going to have a flexible exchange rate. If you don't, then you'll receive a lot of international capital flows, or you'll have a lot of capital outflows, but the market won't allow you to actually have the exchange rate that you want. So all of this might sound a bit too theoretical, but the main takeaway is that the arguments for a flexible rate or against a flexible rate, you're always having this trade-off. You always have this trilemma. So you can always pursue two, but you can't pursue all three. And that's going to be sort of the thing that we think about as affecting this monetary, fiscal policy, and capital flow policy when we talk about exchange rate dynamics. So one of the arguments against flexible rates is that, yeah, we have, when we have flexible rates, by definition, they're flexible. So we're not certain where the Forex market is going to settle. And that uncertainty in some cases can hurt international trade and investment. Another argument that's often made against flexible rates is that it can be really difficult when you have a crisis. There are not very many safeguards to kind of prevent crises. So We'll kind of understand that as we examine the Greek case later in the lecture. But more importantly, I want us to continue to think about all of this through the lens of market efficiency. So market efficiency is a concept that you've heard before quite often. Key idea is that prices are going to react quickly and correctly to new information. We're going to use market efficiency to understand these currency events that we'll be discussing next. So we're going to ask, what's the new piece of information that's revealed? How did the market react? Did prices go up or down? People buying, selling, etc. And then we also want to know, did the market overreact? And when we think about the market overreacting, the way that we'll think through that is by looking at contagion. Okay, so there are trade-offs of monetary unions. On the upside, we've got common exchange rates, common market, lower transaction costs, efficiency gains, increased competitiveness, political cooperation. It's really difficult to go to war when your economies are super intertwined. So on the downside, as we said, you lose national monetary policy, you lose exchange rate policy. And the more trade dependent and the less diversified the country's economy, the more prone to a negative shock that the economy would be. What does that mean? It means if I'm more dependent on trade and the economy has less different sectors within it, then when I have a negative shock, I'm going to have a much harder time of dealing with it. So we'll examine this when we look at the case of Greece. Greece joined the EU in 1999. The EU has limits on budget deficits and debt to GDP ratios for member countries of 3%. In December 2009, Greece revealed that its budget deficit was 12.7%, which was much larger than the 3.7% that was announced by the previous government, which was still in excess of the EU limit. So what happened? Well, first, bank deposits fell as institutions and households moved their money abroad. So you can clearly see that from the revelation of this deficit, there's a dramatic reduction in bank deposits. You can see billions of euros no longer being deposited in Greek banks. What else do you observe? Bond yields rose as investors were worried that the government would not be able to pay back its debt. So the bond yields are going to go up as you worry that it's going to be harder and harder to get paid back. Remember, bond yields and prices kind of move in opposite directions. So if the bond yields are getting smaller and smaller, it's because investors are buying more and more and more of the bonds, so they're pushing the price up. If the opposite happens and the yields are growing larger and larger and larger, it's because the prices are getting lower and lower and lower. So prices and yields move in opposite directions. The last thing is that unemployment rose and GDP fell. So if unemployment is high and GDP is low, it's highly unlikely that there's going to be enough economic activity to have enough tax revenue in order to be able to pay and service debt. So what happened? The IMF and the ECB, the European Central Bank, committed more than 300 billion euros in loans to Greece from 2010 to 2018. Those commitments required that austerity be put in place. And austerity, you can think of austerity as essentially cutting back on fiscal policy. So strict budgets, limits on pension payouts, higher taxes, lower government services, all of it. There were 1 million plus jobs that disappeared from the Greek economy over this 10-year period. So the human and social cost of implementing these policies were incredibly high. Eventually, the economy began to recover, and Greece was able to issue long-term bonds again in 2020. And this is a clip from a Bloomberg article that basically discusses just that, the fact that for the first time in more than a decade, Greece was able to sell long-term debt, 15-year debt. Okay, So hopefully it's very clear from the Greek example that there are going to be trade-offs of monetary union. And if we revisit that idea of the trilemma, remember, we're always trading off those three things. We can have a fixed exchange rate, we can have the free flow of capital between countries, or we can have independent monetary policy. We can have two, but we can't have all three. Okay, so let's